ultimate financial freedom is when you can sit back, relax, and let your dividends from your stocks pay for your lifestyle. Dividends are one of the closest things to true passive income because once you invest in a company that's paying a dividend, you don't gotta go and work at that company. Like if you go and invest in the McDonald's stock, you don't gotta go and flip burgers, but if McDonald's keeps paying the dividend, they'll keep sending you a check every 3 months because they're working hard to grow their profits. I'm gonna be going over a bunch of different dividend paying stocks and ETFs and different dividend strategies that you could potentially use. But the first thing that you have to understand, I know this is the boring part, is why do companies pay dividends? In order for a company to pay a dividend, they first have to be profitable. They have to pay off all their expenses and still have cash in the bank. Now, when they have this cash in the bank, they can do one of a few things. They can save this cash for emergencies. They can invest this cash back into their company. So if you're investing into a guacamole company, they can use this cash to go out and buy an avocado farm, or they can use this cash to pay off their investors. There's 2 different ways that they can pay off their investors. They can use this cash to buy back shares, which pushes stock prices higher, or they can use this cash to pay out dividends. Dividends are literally just cash checks that companies pay out because you own a company and it's your profit distribution. So they take the profits and then they just give it away to the shareholders, people like you who own their stock. If you want to be really strategic about investing in dividends, and I say investing in dividends because you can also trade dividends. The way that you trade dividends is you buy a stock right before it issues its dividend and then you sell it after, but that's a lot riskier. We're not talking about trading here. If you want to be strategic about how you invest in dividends, you have 4 general strategies that you can follow. You can invest in high yielding dividend stocks. You can invest in high dividend growth stocks. These are companies that are growing their dividends. Then you can invest in value companies that pay a dividend. And then you can invest in REITs, real estate investment trusts. I'm going to talk about all 4 of these, but let's start with number 1, talking about high yielding dividend companies. There are so many articles on the internet that give you lists of the highest paying dividend companies. Let me give you a couple examples. You have SCU and ORC. SCU pays a 24% annual dividend yield at the time of me recording this video, and ORC is a 16% yield. This is Sculptor Capital Management, and this is Orchid Island Capital. Now, I picked these 2 randomly out of one of these high dividend paying lists, but let's just talk about what happens if you would invest in these companies and get these type of returns. If your goal right now is to make $2,000 a month from your dividends or $24,000 a year, and you can get a 24% dividend, meaning a 24% return on the cash that you invest, that means you'd only have to invest $100,000 here to SCU or $150,000 here into ORC to get these types of returns. Now, that's not a lot of money considering that typically you would need to invest at least $500,000 to be able to comfortably make $2,000 a month in passive income. So to get that with just $100,000 or $150,000, that's a pretty good deal. So what's the catch? Dividends only show you a piece of the puzzle. When you invest your money, you should not only look at the dividends, you have to look at the company in general, and a dividend is a piece of what the company does. So if you're only looking at the dividends, you're only looking at a piece of the puzzle. When you invest in a company that has super high dividends like this, that typically also comes with very high volatility. That means you can see the stock go up and down, and in order for you to really see and maintain these types of returns, you want to make sure that the company that you invest in isn't going to suddenly tank tomorrow. And when you have these type of dividends, you're going to see a lot of volatility up and down in the stock. And another thing that you want to remember, which becomes extremely apparent when you invest in a company with super high dividends like this, is when the dividend is paid out, many times the company's stock price will fall by the amount of dividend that is paid out. So if a company is trading for, say, $100 a share and they pay out a $3 dividend, the day that the dividend is paid out, many times you're going to see that company's share price fall to $97. This is a lot more apparent when you have these super high dividends, because now when you pay this big dividend, the stock price falls. So if you get this 24% payout, sometimes you might just see the stock price fall by 24% because of the dividend that is paying out. So you need a strong company that can help drive up the stock price in addition to just paying the dividends. Plus, dividends don't tell you what's going on at the company behind the scenes. So let me give you an example. Let's say you find a stock trading for $100 a share and it pays out a $3 annual dividend, which is a 3% annual yield. So you ignore it and you just kind of go past, you do your own thing, and then some time goes by. You forgot that you looked at this company before, but now the company isn't trading for $100 a share, it's trading for $25 a share, but it's still giving that $3 dividend because they haven't changed or updated the dividend policies yet. Now, from a dividend perspective, this is going to look a whole lot more attractive because now if you invest, you would be getting a 12% return on your money, which is a great dividend. But what you don't see when you just look at this is that the stock price has been cut into a fourth. So maybe there are some underlying issues. Maybe the company is on the verge of going bankrupt. Maybe the company is about to cut their dividend. Maybe the company is about to get rid of the dividend completely. So there's a lot more things that you have to look at besides just the dividend price or the dividend percentage. You need to understand what's going on with the company. If you don't like the idea of putting in all that work to research a company, then the next best thing is, instead of investing in a high yielding company, to invest in a high yielding ETF like VYM. Now, I'm not trying to tell you what to invest in, I'm just giving you examples. VYM is a Vanguard high yielding dividend ETF. And the goal of this particular ETF is to invest in a whole bunch of different dividend paying companies. That way it can pay you a sustainable higher dividend yield. The advantage of investing your money in an ETF now is you don't have to try to find the perfect company, because if one of the companies goes bankrupt in the ETF will just kick it out and you'll have some other winners that'll balance it out. But that also is the downfall with investing in ETFs, is you're not going to get the highest returns. Your returns are going to be averaged or normalized, because you're going to have some winners and you're going to have some losers. So you're giving up some of the potential returns so you don't have to take on all the risks. At the time of recording, VYM is paying out a dividend yield of 2.8%, which is significantly less than the high dividend yielding companies that I talked about just a minute ago, which means that if you're trying to get $2,000 a month from your dividends, you would have to invest right around $850,000. Now, it's a lot more than we were just talking about, but your money is going to be a lot safer here than investing your money into an individual company. The second way that you can invest your money to get that dividend passive income is by looking for growth. Now, typically when we talk about growth, especially when we talk about stocks, we're talking about investing your money in a stock that's trading for $100 a share today to hopefully go up to $200 a share sometime in the near future. But when we talk about dividend growth, it's a little bit different. When we talk about dividend growth investing, now we're talking about investing in a company that's paying out a dividend that's growing year after year after year. And you have a few different types of dividend growth companies. You have dividend challengers, sometimes they're referred to as dividend achievers. You have dividend champions, sometimes they're referred to as dividend aristocrats. And then you have dividend kings. All this means is a dividend challenger is a company that has consistently been paying and increasing their dividends over the last 10 years. A dividend champion is a company that has consistently been paying and increasing their dividends over the last 25 years. And a dividend king is a company that has been paying and increasing their dividends over the last 50 years consistently. A few examples of dividend challengers are JP Morgan Chase Bank, Apple, and Pfizer. Both JP Morgan Chase Bank and Pfizer pay around a 3% annual dividend at the time of recording, and Apple's paying around a 0.5% annual dividend. So again, this means that these companies have been paying dividends and increasing them steadily over the last 10 or so years. And if you want to get that same $2,000 a year in cash flow and you're getting about a 3% annual return, that means you'd have to invest $800,000 to get the $2,000 a month in dividend cash flow. With Apple, who's only paying a 0.5% annual dividend, you'd have to invest significantly more. You'd have to invest $4.8 million, but that's because their dividend is only 0.5% a year compared to the threes. A couple examples of dividend champions are IBM and J&J. IBM at the time of this recording pays around a 5% annual dividend, and J&J or Johnson & Johnson pays around a 2.5% annual dividend, which is around the JP Morgan and Pfizer dividend yield. Now, with the 5% annual dividend, you'd only have to invest $480,000 to get the same $2,000 in cash flow a month. And then we have the select few, the dividend kings. These are the companies that have been paying and growing their dividends steadily for the last 50 years or more. And a couple examples of that are Target and Coca-Cola. At the time of this recording, Coca-Cola is paying just under a 3% annual yield, and Target is paying right around a 1.5% annual yield. If we do the math, at a 1.5% yield, you'd have to invest $1.6 million to get that $2,000 a month. And at the 3% annual yield, again, you have to invest about $800,000 to get that same yield. Now, I want to clarify one thing. This is not investment advice. I'm not telling you to invest in these companies. These are just examples that I'm giving you, going over the different types of dividend strategies. But you need to make sure you always do your own due diligence and do your own research, because investing has risks. You're never guaranteed to make money when you invest. You might even lose money, which is why you gotta always do your own due diligence and never blindly listen to a random guy on YouTube. The third way to generate this type of dividend cash flow is by investing your money for value. So up until now, we've been talking about investing your money solely for the dividends. But another way that you can invest your money is investing your money into value-based companies. A value-based company is a company that is profitable, that has good fundamentals, that's creating a good product, and that's innovating for the future. Now, you're investing in this company because you like the company, you believe in the company, but one of the benefits of investing in this company is you get paid a dividend as well. So you don't get necessarily the biggest dividends with these value companies, but you're investing in a strong underlying fundamental company. The reason why I'm talking about value companies instead of growth companies, not growth dividends, but actual growth companies, these are your smaller startup techie type companies. These smaller startup techie type companies usually are not profitable. They're spending every dollar that they can and sometimes more through the help of debt or investment dollars. That way they can grow bigger and faster to grab market share. So if they don't have a profit, they can't pay out a dividend. As opposed to these value companies, these are typically your larger companies that have already established that market share. These are your brand names that everybody knows. A lot of them are the dividend paying companies that we just talked about, like Starbucks, McDonald's, Pfizer, Coca-Cola. These are all dividend paying companies that are also value companies. But what you're investing for here is not necessarily the particular dividend, but the underlying value of the company. So if you don't want to do all the research or doing the fundamental analysis of a company, the next best thing is to invest in an ETF that gives you exposure to these type of companies, and that would be something like VOO or SPY. Both of these are S&P 500 ETFs. I have some of my own money personally invested into VOO. They both give you exposure to the biggest 500 companies on the stock market. That's what the S&P 500 is. So when you invest in VOO or SPY, you're investing because you want to get exposure to the biggest 500 companies on the stock market. But one of the benefits that you get kind of as a side benefit is you also get a dividend. At the time of recording this video, you get approximately a 1.3% annual dividend for investing into these S&P 500 ETFs. That means if you wanted to go out and invest in these ETFs today and start generating $2,000 a month in passive income tomorrow, you'd have to invest something like $1.8 million in order to do that. But the other benefit that you get here is that over the last 10 years, we've seen VOO particularly, it's about the exact same for SPY, we've seen VOO grow by more than 14% a year on average over the last 10 years. Which means if 10 years ago you invested $10,000 into this, not only would you be getting a little dividend, but you're also seeing a 14% annual growth on your money. So you would have 4 times your principal over the last 10 years. So if you invested $10,000 10 years ago, that would be $40,000 today, and you'd also get some dividends along the way. And the fourth way that you can invest for this type of dividend income is by investing your money in REITs, which are real estate investment trusts. These are types of stocks in the stock market, and the reason why I give REITs their own category is because REITs follow some unique rules. So the way that these companies work is these are companies that go out, they build and they buy real estate, and they make money through rent. So tenants live in these apartment complexes, they pay rent to the company, and then this company makes a profit. Well, these companies are required to follow the 90% rule, which says that they're required to distribute 90% of their taxable income, meaning their profit, over to shareholders through dividends. So these companies are required to pay out most of the profits in dividends, which is why many times you're going to see REITs pay out higher dividends. So if you're looking for a way to invest in real estate, I personally am not a huge fan of REITs. I like investing in actual real estate. But for the people that love investing in stocks, they like REITs because it gives them exposure to real estate without having to actually invest in real estate. It's not for me, but let's talk about REITs for a second. A couple examples of this, again, I'm not telling you what to invest in, just a couple examples, is SPG, Simon Property Group. This is a very popular REIT. This is a company that invests in real estate, and at the time we're recording this video, they're paying around a 5% annual dividend. Now, the alternative to invest in individual companies would be to invest in an ETF. Again, this is another Vanguard ETF. VNQ is the Vanguard Real Estate ETF. This is an ETF that invests in a bunch of different REITs, and at the time of recording, VNQ is paying around a 2.2% annual dividend yield. So a couple ways that you can get dividends from the REIT sector are one, through investing in individual companies, or by investing in ETFs that give you exposure to REITs. The last thing that I want to mention about this, which is arguably the most important thing, is no matter what strategy you pick, if you want to succeed with a dividend strategy, the key is not to just invest all of your money today. The key is to be a consistent investor. That means you create a system where every week, every 2 weeks, every month, you find whatever it is that you want to invest in, stocks, ETFs, and you're just going to keep investing your money into these stocks and ETFs. That way you can build up your portfolio over time, because most of us don't have a couple $1 million just laying around in a bank account to just go out and make a big purchase. So what you want to do is you want to create a system where every time you get paid, some of your money is automatically buying whatever it is that you want to buy. Then, if you really want to grow your dividends even faster, you want to create a DRIP, dividend reinvestment plan, where now as soon as you get paid the dividends, this money goes back into the company to buy you more shares of the company. That way you can get even more dividends. So if you don't need the cash flow right now, using this dividend reinvestment plan allows you to keep buying up more shares of the company, which gives you a bigger piece of ownership, which ultimately pays you with bigger dividends. Now, if you're investing in a strong company where the value is going up and they're paying higher dividends, the value that you're getting just keeps compounding and compounding, because now you're investing your money today, you're buying shares of a company that's going up, and you're buying dividends that keep increasing, and the dividends that you're getting are being reinvested to keep buying more shares of this company, which will ultimately pay you with more dividends. So this is why it's so important to not just blindly throw your money into a company that pays out a dividend. You need to do the fundamental research. That way you can invest your money into a company that will continually keep growing and innovating and produce bigger profits for you, because that's how you're going to get the biggest bang for your buck, instead of just trying to get the high dividend today because you see a big dividend yield that you want to capitalize on right now.
We're going to jump back into the show in just a minute, but before we do, here are a few words from our sponsor, Policygenius. Term life insurance is a financial tool that you can use to protect your family in case of a tragedy, because if you are the breadwinner of a family and if something were to tragically happen to you and you lost your life, well, that's when term life insurance would kick in and give your family a check. That way, at least your family would be okay financially. Now, if you are looking for term life insurance, Policygenius can help you because they are an insurance marketplace, so they can help you save money and find the best option for you. See, Policygenius is an insurance marketplace. They're not an insurance carrier. So the way it works is you go onto their website and enter in a few pieces of information, which just takes a few minutes, and then they will present you with different term life insurance quotes from different insurance carriers. That way you can pick the best option for you. The Policygenius service is completely free to use, and if you have questions, you can talk to a Policygenius insurance expert and get unbiased advice to find the best option for you. The Policygenius service is completely free, and if you have specific questions, you can talk to a Policygenius insurance expert and get unbiased advice. So if you want to learn more and get a free term life insurance quote, I got the link to where you can do that with our sponsor Policygenius down in the description below. Minority Mindset is a paid partner with Policygenius, meaning if you use them, we will get compensated, but there's no additional cost to you. So if you want to learn more and get a free term life insurance quote with Policygenius, I got the link to how you can do that down in the description below. And with that, let's go back to the show.
Everybody says that if you want to become rich and wealthy, all you have to do is throw your money in the stock market. But if it was so easy, why are so many people losing money in the stock market? That's why in this video, I'm going to give you a comprehensive guide on investing your money in the stock market. And if you watch this video until the end, you are going to know more about investing in the stock market than the vast majority of people. The stock market is one of the most accessible wealth building tools that we have, but the issue is most of us are never taught about how to use the stock market the right way. For a lot of people, stock market investing is finding a hot stock, throwing your money into it, and then watching your money disappear. Oh, not again. If you really want to understand the stock market, there's 5 things you need to know. First, you need to understand what is the stock market. In this section, I'm going to be going over what's the Dow Jones, NASDAQ, S&P 500, why does the stock market exist, and how do stocks work. After that, we're going to be talking about how you can make money. So this is the difference between making money through dividends and appreciation, what causes a stock to go up. Then we're going to talk about different investing strategies. You might have heard people talk about fundamental analysis, technical analysis. I'll be talking about active investing and passive investing in this section. Then I'm going to be talking about some of the different investment options you have. You might have heard people talk about things like growth stocks, blue chip stocks, REITs. We're also going to be talking about mutual funds, index funds, and ETFs. And then we're going to wrap it up by talking about how do you actually research the stocks and take action. So this is looking at things like 10Ks, 10Qs, researching stock charts. This is where you actually are making the money because now you're taking action. I'm going to be going over these 5 things in this video, but before I do that, I need you to do me a quick favor and smash that thumbs up button below, because the way the YouTube algorithm works, if you do not smash that thumbs up button, then YouTube is much less likely to show you and other people our financial news and education videos. Let's start with this. What in the world is the stock market? The stock market is a place where you and I, regular people, can go and invest in companies. When you invest in a company, you become one of the owners of a company. So if you go out and you buy one of the shares of the McDonald's stock, you become one of the owners of McDonald's. Now, if you just buy one stock, you're not a major shareholder. I mean, you only own 1/750 millionth of the company, but you're still one of the owners of McDonald's. And as an owner, you actually get the right to vote on some of McDonald's business decisions. A company that trades on the stock market is known as a public company because this company is publicly traded, meaning anybody can go and buy shares of this company on the stock market. You can compare that to a private company, kind of like ours, Minority Mindset, because you can't buy shares of Minority Mindset on the stock market. If you wanted to buy an ownership stake in Minority Mindset, you would have to call me up and I would say, sorry, we're not selling. The reason the stock market exists is it's a way for companies to finance the future growth. So if you are a big company and you need more cash to grow, then what you could do is you could sell 20% of your company now instead of to private investors to the public market on the stock market by now giving this 20% of ownership to the public on the stock market. Now you are a publicly traded company and everybody knows how much your company is worth and people have the opportunity to buy shares in your company. When you hear people say things like the stock market is up or the stock market is down, what they usually mean is an index like the Dow Jones or the S&P 500 or the NASDAQ is up or down. So these are called indexes because they're essentially baskets or groups of stocks. The Dow Jones is a group of 30 very big companies. The S&P 500 is a group of 500 of the largest companies on the stock market. And the NASDAQ is a group of tech companies. So they're called indexes because they're groups of stocks. And they essentially just give you a sample of what's going on in the broader stock market. When you invest in the stock market, you can invest into individual companies like McDonald's. I mentioned that just a minute ago. Or you can invest in an index and get exposure to the broader stock market. But I'll be talking about that in just a little bit. Second, how do you make money in the stock market? Well, in general, the goal in the stock market is to invest in a company that becomes more profitable and makes more money. That way you make money, but the way you make money is one of two ways. When you invest in the stock market, you can make money through appreciation or dividends. Appreciation is when you invest in a company and the value of a company goes up. So if you invest in a stock and you buy the stock at $100 a share and 2 years later the stock goes to $200 a share and you sell it, the $100 of profit that you just made is called appreciation. Other times you can also make money through dividends. Dividends are literally just cash payments that a company gives you because you invested in a company. So if you go out and invest in a company that's trading for $100 a share, sometimes this company is going to send you a $5 check every single year just because you own shares of this company. You can think of it this way. When a company is mature and they have a lot of cash and a lot of profits, there's three things that they can do with their extra cash. They can save this cash for an emergency. They can invest this money back into their business. That way they can grow bigger. Or they can reward you, the shareholders, the investors, by giving you some cash. That way now you're happy for investing in this company and this will attract more investors to want to invest in this company. Most dividends are paid quarterly, meaning every 3 months. So if you invest in a company that pays a dividend, you're going to get a check every 3 months. Or if you want, you can have this cash reinvested into your stock. That way now instead of getting a physical check, you are getting more stock in the company. Now, dividends sound cool. I'm a big fan of dividends, but there are a couple drawbacks with dividends that I want you to understand. First, when a company pays a dividend, you have to understand that means the company is not necessarily going to grow as fast, because if a company is paying out $1 billion in dividends, then that's $1 billion the company is not using to actually grow the company to make more profits and make more revenue. So if you have a company that's paying out a lot of dividends, you're typically not going to see as much appreciation as you would if a company was using this money that's spent on dividends to actually grow the company. So if a company is paying out dividends, they're usually more stable companies and they're bigger companies because they have a lot of cash that they don't really want to invest back into the company, so they're rewarding their owners with the dividends. Second, with dividends, you have to pay taxes on your profits. So this is kind of like your pro and con. You have to pay taxes on all of your income, but with dividends, if you are reinvesting your dividends back into the company, you're not getting this cash in your hand, but you still have to pay taxes on the profits that you got. Not every company pays a dividend. So if this is something you're interested in, you have to look into the actual company and see if they're paying a dividend or not. And like I was saying before, the companies that pay dividends are typically your larger, kind of more mature and established companies, because your smaller companies, your growth companies, your tech companies, the ones that are really trying to grow fast, they're investing every dollar they can back into the company because their goal is to grow as big as possible, as fast as possible. So companies like that, Their goal is to grow their stock price as fast as they can. The advantage with that, if you're investing in a company that's investing heavily in their growth, is you don't have to pay taxes on dividends because you're not getting any dividends. A company is investing their money back into the company, so hopefully you have a big stock price and you don't have to pay any taxes on your appreciation until you actually sell your stock. So that's one of the advantages of appreciation. But one of the downfalls is it also comes with more risk because there's a chance that the company will fail, and if the company fails, you don't have anything to show for it because you didn't get any cash through dividends. So they both have the pros and cons, and as an investor, you need to know why you're investing. Are you investing for this or this? The question now you might be wondering is what causes a stock price to go up? Well, on a very broad level and a very simple level, stock prices go up based on supply and demand. If you have a lot of demand to buy a stock and there's not a huge supply of stock, then the price of the stock is going to go up because you're going to have buyers that are fighting each other to buy the stock, and this is going to push the stock price up. And if you have a lot of supply but no demand because nobody wants to buy the stock, then you're going to see the price of the stock fall. In the short term, the supply and demand is really fueled by emotion. Like people might think, oh my God, Tesla is the future, and everybody gets behind Tesla, and then you see this huge demand to buy Tesla, so the price of Tesla stock goes up. But in the long run, what really affects the stock's price is its fundamentals. That's how much money is the company making, how are their profits looking, are their revenues growing, are their profits growing, how is the management, and are they innovating for the future? So these are the things that really affect a company's stock price over the long term. But in the short term, a company's stock price can be really volatile based off of people's emotions because the stock market is emotional. If you want to invest in stocks, it is very simple. All you have to do is open up a free account with a stock brokerage, and then you can buy or sell whatever stocks you want. Back in the day, it wasn't so easy. Back in the day, if you wanted to invest in the stock market, you'd have to call up a stockbroker, and then the stockbroker would then have to make a deal with Wall Street and then buy or sell whatever stock you want. It was a very long and difficult process, but now it is very simple. Third, let's talk about investing strategies, because there's more than one way to invest in the stock market, and this is one of the biggest mistakes that people make when they invest in the stock market, because for a lot of people, their strategy is invest in a company that I think is going to be big, and then when it goes down, sell it for a loss. There's a lot of ways to invest in the stock market, and you need to have a strategy on how you're going to make money. If you want to be a stock market investor, then when you buy an investment, your goal should be to own your investment for at least a year. Because if you don't own your investment for at least a year, then you're also going to be subject to higher taxes, because the way that the tax code works, if you own your investment for longer than a year, then that's categorized as long-term capital gains and you get lower tax rates. But if you buy a stock and sell it for a profit in less than a year, then you're going to be subject to higher taxes called your ordinary income taxes, because the United States government and the IRS doesn't look at that as an investment, because now you're just trading, you're flipping stocks. This isn't to say that you cannot make money trading stocks. This is for you to understand what your goal is as an investor, because if you don't know what your goal is as an investor, you're not going to be able to come up with a strategy. On the very highest level, there are two different kinds of investment strategies. There is an active way of investing in the stock market and a passive way. An active investment strategy means that you're now actively researching companies and stocks and you're buying based off of that. And passive means you're not really doing much research. You just have some money automatically being invested for you every week or every month. Now, within this type of active investing, there's a whole bunch of different strategies that you can use, but they ultimately come down to doing two different types of research. You can either do fundamental research, so I'm gonna call it fund, or technical research. Or you can also do both depending on what strategy you have, but those are the two types of research you can do, fundamental or technical. As a passive investor, you're mainly going to be looking at the fundamental type of research. Fundamental research means you're looking at the company itself. You're looking at how much money a company is making, what their profits are, who the management is, and how they're innovating. Technical research means you're looking at stock charts. You're looking at momentum. You're saying, oh, this company looks like it's about to go up because of all these indicators, and so you buy based off of that. Warren Buffett is a fundamental investor. He likes to look at companies, he likes to read financial statements, and he wants to find a company that's undervalued, and he wants to own it for a long time. That way he can make a profit over the long term. And he is an active investor because he does the research to actually find the companies to invest in, and he is the one that's picking these stocks and doing this research, and he makes these decisions when he thinks it's a good time to invest. You can compare that to a passive fundamental investment, where now you can pick a few stocks or a few funds that you want to own, and then every single month you have $100 or $1,000 or $10,000, whatever you can afford. You have this money going into your investments, being divided up into your 3 or 5 funds, whatever you have, and this is just passively happening without you actively trying to find new funds. It's just every month or every week, more money is just being invested into your account. Technical trading is now when you're looking at stock charts and you're looking at momentum. You're looking at different indicators that tell you that you think the stock price is going to go up. Maybe you're looking at how many people are buying the stocks of the volume. Maybe you're looking at moving averages to kind of see the trend of which way the stock price is moving. So you're looking at different indicators to tell you that you think the stock market is going up, at least in the short term. If you don't like the idea of putting time into the stock market, or if you don't care about studying companies, or if you don't care about stock charts, then passive investing is probably best for you because this one requires the least amount of work. You find a few stocks or funds that you want to invest in, and then every week or every month, you are just going to continue to put money into that. If you like the idea of looking at companies, but you don't like the idea of looking at stock charts or looking at these moving averages, you just want to invest in a company like Warren Buffett does because you want to find an undervalued company and invest in it for the long term, then being an active fundamental investor is probably best for you. If you don't like the idea of waiting years to potentially see a profit, then technical investing is probably better for you. Now, while technical investing can make you the most money in the short term, it also comes with the most risk because your goal is to make money in a shorter amount of time. A lot of technical investors are buying and selling stocks within a year. Fundamental investors are usually looking to make money over the long term. So now we're talking multiple years, and so there's less risk, but also less opportunity to make a whole bunch of money very quickly. For the vast majority of people who don't care about studying companies or reading financial statements or spending time learning the stock market, passive investing is the right way to go. Now, I already made a video where I went over passive investing in good detail, so if you want to watch that video, I will link it for you in the description below. Fourth, let's talk about the different types of investments on the stock market, because one way you can invest in the stock market is by investing in stocks. But that's not the only way that you can invest in the stock market. You can invest in the stock market and make money in the stock market by investing in individual stocks. You can invest in mutual funds, you can invest in index funds, and you can invest in ETFs. If you are subscribed to our YouTube channel, you've probably heard me talk about these things before, and if you're not subscribed to our YouTube channel, you should probably do that. Stocks are when you're investing in individual companies. This is what I've been talking about most of this video. So if you invest in the McDonald's company, or in Lululemon, or in Tesla, or in Amazon, or in Apple, now you're investing in individual companies. And within the stock segment, there are different types of stocks out there. Like you can invest in blue chip companies. These are your more stable, more established, your larger companies. You can invest in growth companies. Growth companies are your startups, your smaller companies. These are companies that are investing heavily into their growth. So growth companies are not companies that are paying out dividends. These are companies that are spending every dollar they have back into their company to grow as big as possible, as fast as possible. So more risk, but the opportunity to see more appreciation. You have things like REIT stocks. REIT stocks stand for Real Estate Investment Trusts. These are companies that pay out high dividends because these companies make money through rent, and the law says that REIT stocks are required to pay you 90% of their taxable income through dividends. So REITs give people exposure to real estate, and you can make income through dividends without having to go out and physically buy real estate. So these are a few ways that you can invest in stocks. And again, you want to invest in stocks based off of your investment strategy, your investment goals. But this isn't the only way to invest in the stock market, because the downfall with investing in stocks is if you invest your money in a stock, let's say Amazon, and Amazon starts to fail, they start losing money and they go out of business, then all of your money goes down the drain. Now you might be thinking, oh, Amazon's never gonna fail. But you know, companies do fail. And if you invest in a company that fails, then all of your money is gone. That's where these options come in handy. Mutual funds are indexes, so a group of stocks that are managed by a very experienced and usually a very expensive money manager. So when you invest in a mutual fund, you are paying this money manager to find you a portfolio and investment of stocks, and this person is going to manage your stock portfolio, and their goal is to help you beat the market, and in exchange, you're going to pay them a fee. Index funds work very similar to mutual funds, except with index funds, you're not paying a money manager to manage your account. This is passively managed by a computer. So essentially with an index fund, you can invest into an index, like you can invest into an index that gives you exposure to the top 500 companies on the stock market. And now if these top 500 companies go up, your index fund goes up. If these top 500 companies go down, your index goes down. The advantage with index funds is you tend to have low fees, you tend to have less risk, and you can typically match the returns of the stock market. The downfall is you typically have less potential upside because you might have some great companies in your fund, but they're going to be balanced out by the losers. But this can be a good way for you to invest and get low fees and get exposure to the general stock market. An ETF is an exchange traded fund, And this is kind of like a basket statement because all this means is this is a fund that you can buy and sell on a digital stock brokerage. So the reason the word ETF even exists is because a lot of mutual funds cannot be bought and sold on the stock market. If you want to buy a lot of mutual funds, you have to call up a broker and purchase shares of a mutual fund manually. With an ETF, it's all electronic. So you can buy and sell shares of this ETF kind of like you would any other stock. Now look, I am just a random guy on YouTube, okay? So you should always do your own due diligence and never blindly listen to a random guy on YouTube because investing has risks and you are never guaranteed to make money when you invest. But a couple examples of index funds that give you exposure to the general stock market are VOO and SPY. If you invest in one of these two funds, you will get exposure to the top 500 companies in the stock market, and now you don't have to go out and try to find the best stock to invest in. Now you're investing in the general stock market. I want to kind of give you an idea of what long-term returns in the stock market look like when you play the stock market for the long game. So over the long term, the stock market typically goes up by somewhere between 7 and 10% a year. Now, this doesn't mean the stock market always goes up, and this doesn't mean that it always goes up by 7 to 10% a year. This means on average, it goes up by 7 to 10% a year. Some years it'll be more, some years it'll be less. Sticking with the lower end of the equation, let's say you invest $10 a day or $300 a month, and you can get a 7% return on your money, and let's say you do this for 45 years. So you start doing this when you are 21 years old, and you continue to do this until you retire at 66. If you do this, and every single month you invest $300, you will retire with $1.1 million from your $10 a day investment. The reason I want to show you this because let's say you start a little bit later. Let's say you start investing not at 21, but now at 31, and you continue to do this until you're 66. So now this is 35 years, but you're still doing the same investment. You're still doing $10 a day or $300 a month. Now, if you do the same investment, you're not going to retire with $1.1 million. You're going to retire with $535,000. Still a lot of money, but you're leaving a lot of money on the table because your money doesn't have as much time to compound. Time is very important when it comes to investing your money over the long term because every single year your money has more time to grow and compound, and the longer you let your money grow, the more wealth it's going to build you. If you want to grow your money even more, then there's two things you can do. You can either invest more money or invest your money more aggressively, meaning get a better rate of return. So let's assume now that you're investing $20 a day and you continue to get the 7% return a year. If you do this for 45 years, so you start when you're 21 and you continue to do this until you're 66, then you are going to retire with over $2.2 million from your $600 a month investment. If you cut 10 years out of the equation because you didn't know about investing until you're 31, so you do this for 35 years, now you will only retire with $1 million. Now, I know, only $1 million. $1 million is still a lot of money, but you're leaving a lot of money on the table by not starting sooner. This is where a lot of people say things like, oh, I didn't start investing when I was younger. Did I miss my shot at becoming wealthy? Is it too late for me to start investing? No, it's not. Remember what I said before. If you want to get better returns, you either have to invest more money or invest more aggressively. Maybe you have to invest more money, or maybe you have to be a little bit more active with your investments. That way you can get a better return. So now let's go through this example again, where you're investing $20 a day and now you're a little bit more aggressive. So you're trying to get a 10% return. If you do this for 45 years, just to show you the example, now you're going to end up with $5.5 million. If you start a little bit later at 31 years old and you do this for 35 years, now you're going to end up with $2.2 million. So you're still a millionaire. And if you start this at 41 years old, now you only do this for 25 years, you're still going to end up with $750,000 in retirement. So time and consistency are very important for you to build this wealth over the long term. And if you're trying to make up for this lost time, then you need to either invest more aggressively or invest more money. And if you don't have extra money to invest, then you might have to look into doing something like a side hustle or starting your own business. That way you have extra cash to invest. That way you can build your wealth. And this is also more of a passive investing structure. Right now, you're not trying to get amazing returns. You're just trying to match the market by passively investing your money into a fund that gives you the same returns as the stock market. Active returns can get you better returns, but again, it comes with more risk. Like if you had invested $10,000 in Amazon back in 2010, that $10,000 investment would have grown to $170,000 in 2020, but that again comes with more risk because there's a lot of companies that didn't get the same returns as Amazon. Now, when it comes to research and taking action on your investments, you have to understand that the investors that make the most money are not the investors that invest on emotion.
It's the investors that invest on financials. A lot of people are investing in the stock market when they feel excited because they think, oh my God, so many people are making money in this stock, so let me buy in. And then when the stock starts to come down, they panic and they sell. If I had to diagram it out for you, it looks something like this. So you see a stock go up like this, then somebody at this point gets excited, they get greedy and they say, oh, everybody's making so much money because the stock has shot up so much. So now they come in and buy at the peak. And then people realize that, oh, this stock might be a little overvalued. So they start taking off their profits right here. And what do you see happen? The stock price starts to come down. And now when the stock starts to come down, people start to panic sell. And now this is where you sell because you panic, you get worried, you see your stock in the red, and so people sell. I do not want you to be an emotional investor. I want you to be a financial investor, which means you need to know how to do the research. That way you can find the information you need to actually invest in a company for the long term to make money. When a company is publicly traded, so it's on the stock market, it is required by the SEC to release certain information about the company. That way people like you, investors, can make smart decisions. One of the things that a company is required to do is every 3 months or every quarter, it is required to have an earnings call where it releases something called a 10Q. A 10Q is its quarterly, so every 3 months, a quarterly financial statement. This statement will tell you how much money a company made, how much revenue it made, how much profit it made, how much money it lost. This is how much money it made over the last quarter that it's reporting for. But what you need to remember about the 10Q is these are unaudited statements. So these are statements just released by the company. A 10K is an annual statement released by a company. So every single year, a company is going to have to compile all of their financial data for the last year, how much money they made, how much money they lost, where their money is going, and all of that information, and they're going to compile it into the 10K. The interesting thing about the 10K is this is supposed to be a little bit more accurate because these are financially audited statements. You want to be reading the information that's on these documents. Now, if you don't want to actually read these actual financial statements, what you can do is go to a stock website like Seeking Alpha or finance.yahoo.com. I'll link these for you in the description. You can go to these websites and they're going to break down the information that's in these financial statements. So you can go there and see how much revenue a company is making, how their revenues have been growing, how their profits have been doing, and everything else, and they will list it out for you. That way you can look at the financials of a company. When it comes to doing technical analysis, that's when you're going to want to be looking at stock charts. So you can go to a website like stockcharts.com, and then you can look at different indicators for a stock. There are tons and tons and tons of different indicators out there, and so what you want to do is create a strategy that you follow, because one indicator might tell you to sell and another indicator might tell you to buy. So you need to make sure that you have your own strategy and look at the indicators for that and follow your investment goals based off of your strategy, because if you don't, then you're going to go down this rabbit hole of never knowing what to buy and when to sell, and it is going to be very overwhelming. We're going to jump back into the video in just a second, but before we do, here are a few words from our sponsor, Fundrise. But before I give you this advertisement, I do have to give you a disclaimer, which is that I do have some of my own personal money invested in Fundrise, and I also own some equity in the Fundrise company as well. If you've been thinking about investing in real estate, but you don't want to deal with the headache of property ownership, Fundrise makes it easy for anybody to get exposure to real estate investments with as little as $10. And now you don't have to worry about going out and buying a property yourself. You don't have to worry about managing tenants, and you don't have to worry about unclogging toilets. The way it works is you invest your money into Fundrise and you're getting exposure to a portfolio of real estate properties. And then you will get paid your share of appreciation and cash flow if your fund makes money. Remember, this is investing at the end of the day. Investing has risks. You are never guaranteed to make money when you invest. In fact, you will probably lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. The nice thing about Fundrise, though, is now you can passively invest your money into real estate without having to deal with all the headache of property ownership. Second, Fundrise has an auto invest feature. That way, if you want to continually invest more money into real estate, you can do that through Fundrise. And third, they have a very cool dashboard that you can use to track the progress of your investments. Now, the last thing that I want to remind you is that when you invest your money in Fundrise or real estate in general, your money is not as liquid as it is when you invest your money into the stock market. So you have to remember, if you're going to invest your money in real estate, whether it's to buy an individual property or to invest your money into a fund through Fundrise, you are investing your money for the long term because you're investing your money in real estate. So if you want to learn more and see how you can start investing with Fundrise, I got the link to how you can do that down in the description below. Minority Mindset is a paid partner with Fundrise, meaning if you use them, we will get compensated, but there's no additional cost to you. So if you want to learn more and see how you can start investing in real estate through Fundrise, I got the link to how you can do that down in the description below, where you can go to theminoritymindset.com/Fundrise. That's theminoritymindset.com/Fundrise. And with that, we'll go back to the show.
If you've been looking for specific ETFs to invest your money to build wealth and compound your wealth, you are in the right place, because in this video, I'm going to be going over 3 different ETF strategies that you can use right now to start building and compounding your wealth. I have 2 different strategies when it comes to investing my own money in the market. I have a passive strategy and an active strategy. My active strategy is where I'm looking for companies, individual stocks, and when these companies go down in price, that's when I come in and buy. So it's more active because I'm actively watching the price of these stocks. I want to see a good price for me to come in and buy, and I'm actively researching each one of these companies. I'm listening to their earnings calls, I'm paying attention to their cash flows. So I'm paying attention to what these companies are doing, and when I see a good price, that's when I come in and buy. My passive strategy is when I buy ETFs. So an ETF is an exchange traded fund, and every week I have a strategy where money leaves my account and automatically gets invested into these ETFs that I've already pre-selected. It doesn't matter if the market is up or down. My passive strategy happens every single week, and this happens passively and automatically, where money automatically leaves my account and it gets invested into these ETFs. You can think of investing in an ETF like investing in a group of stocks, because if you go out and let's say you invest in the Amazon company, AMZN, and you think that Amazon is going to rule the world, you buy their stock, but then something happens. Their executives run the company into the ground, and now the Amazon company goes bust. Well, now so does your investment, because now you invested your money into this company and you're hoping to see a lot of upside because you did your research. You're hoping that this company would grow, but you were wrong. If this were to happen, now you lose your investment. Versus if you invest in an ETF, now you invest in a group of stocks. So this ETF might have companies like Amazon. Now, I'm not saying this is what's going to happen to Amazon, just an example, but this ETF might have Amazon and McDonald's and Coca-Cola and a whole bunch of other companies. Now, if Amazon were to go bust, you're okay, because your ETF doesn't just have Amazon. It has Amazon and hundreds of other companies in there, and you're getting exposure to all these companies. So if one company were to go bust, if one company were to go bankrupt, you're okay, because you have other companies to balance it out. The advantage with this is obviously you have less risk, because now you're not just investing in one company, you're investing in a whole bunch of different companies, and it requires less work on your end, because now you don't have to individually research every single one of these companies. You find the right ETF, you buy it, and then you just keep letting the ETF do its thing. The downfall with ETFs is you also limit some of your upside, because now instead of just investing in one company, you're investing in a whole bunch of companies, and if now the opposite happens, you invested in Amazon and they did take over the world, they started ruling the world, well, now your investment here will be worth way more. And in this case, you'd have Amazon in your ETF, but it'd be balanced out by some of the losers. So with ETFs, you get more kind of a normalized return, because you have some winners and you have some losers, which are balanced out. But in this case, you also have the risk of your company going bust, and you have to put in all the research. So for most people who don't want to put in all the work, or who don't want to take on the extra risk, and who don't want to keep up with companies, they just want to invest their money in the market and let the market do its thing without investing all that time. Well, ETFs are a better and easier strategy for you, and that's why I want to go over 3 different types of ETFs with specific ETFs that you want to consider investing your money in. That way you can grow and compound your wealth. So let's start by talking about the first kind of ETFs that you want to consider investing your money in. That way you can grow and compound your wealth. But before I get into that, I need you to do me a quick favor and smash the thumbs up button below. And if you haven't already, be sure to join our free Discord server called the Guac Talk community. We call it Guac Talk because, as we all know, extra guac is truly a symbol of extra wealth, and in this community you can chat about all things minority mindset. You can chat about the stock market, the real estate market, the cryptocurrency market, and all things building wealth. This community is completely free, and it's a place for you to network with and talk with other minority mindset thinkers. So if you want to learn more and check out our free Discord server, I'll put the link to where you can do that in the description below. So the first kind of ETF that you want to consider investing your money in is an ETF that gives you exposure to the S&P 500. A couple examples of this would be VOO and SPY. Now, a couple disclaimers before I get into this. You are never guaranteed to make money when you invest. You might even lose money. So you should always do your own due diligence and never blindly listen to a random guy on YouTube. I'm going to be talking about a bunch of different ETFs in this video. Some of them I have invested my money in myself, and I will give you those disclosures, like I've invested my own money in VOO. But the reason why I say you need to always do your own due diligence is because what's right for me isn't always going to be right for you. So just make sure you do your own research. The S&P 500 is an index, meaning group of stocks, which are the biggest 500 companies on the stock market. So if you go to the stock market and you pick out the 500 biggest companies by market cap, meaning the valuation of these companies, this gives you the S&P 500. Now, instead of you going out and individually investing in all 500 of these companies, you can invest in something like VOO or SPY. These are the ticker symbols for the ETFs. If you invest in either one of these, you are now indirectly investing in all 500 of these companies, because VOO and SPY both invest in the S&P 500. They give you exposure to the S&P 500, the biggest 500 companies on the stock market. Now, when it comes time for you to actually invest your money into an ETF, there are three big questions you always want to ask. The first question is, who made the ETF? Second is, what do these ETFs actually invest in and what percentage of each company? And third is fees, because you don't want to give all your money to fees. And so you got to understand these three questions to help you understand where you should actually put your money. So let's start talking here. Who made this ETF? VOO is an ETF made by Vanguard, and SPY is an ETF made by Spider, SPDR, they're pronounced Spider. But these are two different companies, both investment companies that create ETFs, which allow you to now buy ETFs. Both Vanguard and Spider are both very reputable companies. And so when it comes time for you to actually research ETFs, you want to look at how credible is the company that created the ETF, because you're going to have a whole bunch of newer, no-name companies releasing ETFs and index funds all the time. But if they have no credibility, they have no history, you don't want to just dump your money into them, because what if they go bust? So you want to look at who made this ETF, Vanguard and the Spider, and also along with that, how many people are actually investing their money into these ETFs? How big are these ETFs? The easiest way to find that information is just to go onto the Vanguard website or the Spider website and actually look at these ETFs. They'll have a fact sheet that will give you a bunch of information, everything you need to know about the ETF itself. So if you go onto the Vanguard website, here I'm on the VOO page, and you see it says the fund total net assets, which is $829 billion for VOO. And then if I come onto the Spider website under index statistics, it says the weighted average market cap, which is currently 668 million, which is $668 billion. If you search online, the general rule of thumb is if you're investing in an ETF, you want to look for an ETF that has at least $10 million in market cap of actually assets that are being managed in order for it to be an actual worthwhile investment to protect your money. But I like to look at something a little bit safer, especially if it's an ETF, because I want my money to be safe. So I'm looking at least $100 million on the low end of assets under management. And both of these in the hundreds of billions are way past that. So we know that one, they're made by a company that's credible, and second, that they have enough assets under management for it to be an okay investment. The second question you want to ask yourself is, what companies do these two ETFs invest in? So we know that both of these ETFs give you exposure to the S&P 500, meaning they both invest in the same 500 companies, but they don't invest in the same 500 companies with the same ratios. Let me show you what I mean. So I'm going back onto the Vanguard website, and right now I can see that the 10 largest holdings are number 1, Microsoft, number 2, Apple, number 3, Alphabet, which is Google, 4, Amazon, Tesla, and on and on and on. But if I go to SPY, I'm going to see here at the top holdings, number 1 is Apple. Number 2 is Microsoft. Number 3 is Amazon. Number 4 is Tesla. Number 5 is Alphabet. So you can see it's very similar companies, but what you see is that the percentages are different, because in SPY, Apple is the number 1 holding versus in Vanguard, Microsoft is the number 1 holding. This question is going to have a lot bigger implications in the other ETFs that I talk about, because those other ETFs are going to be investing in different companies and different types of companies. But in this case, both of these ETFs are investing in the same companies, just in a different ratio and a different percentage of each one. So you can take a look at them, see what their top holdings are, and see which ones you like better. Now, in general, you don't need to spend a ton of time trying to get into the nitty-gritty of each individual company in in these ETFs because the whole point of investing your money into an ETF is for it to be passive. And so you just want to get a kind of general idea of which companies that they're investing in. And if you like the companies, then the ETF might be a good investment for you. And the third question you want to ask before you invest your money into any ETF or index fund or mutual fund or really any investment is, what are the fees? So in general, ETFs have much lower fees than something like a mutual fund because these ETFs are passively managed. So a mutual fund, which is something that a lot of people are familiar with, is when you invest your money into this fund, but it's managed by a person, this money manager. And because it's actively managed by a person, their goal is now trying to beat the market, and they're also going to charge you a lot higher fees. And the problem with that is, sure, they're trying to beat the market, but over the long term, most money managers cannot beat the market year after year after year, so you end up actually losing because you also have to pay much higher fees on top of all of that. Now, there are some instances where a mutual fund can be beneficial if you can get access to the right mutual fund, but in general, that's the thing that you got to be aware of. With ETFs, generally, you have much lower fees because now they're passively managed, meaning that they're managed by a computer. So a computer is going to look at the index, they're going to look at the rules. The rules are here that it's investing in the biggest 500 companies on the stock market. So if a company becomes smaller than one of these top 500 companies, the computer is going to kick that company out and add in a new company. So it's very passive, which is why your fees are less, but you still want to pay attention to what the fees are. The way you do that is by looking at the expense ratio, and here on the Vanguard website, you'll see that the VOO expense ratio is 0.03%, and on the SPDR Spider website, you'll see that the gross expense ratio is 0.0945%. So the expense ratio or fees for VOO and SPY are both extremely low, but the SPY fees or expense ratio is about 3 times higher than VOO, but relatively, they're both very, very, very little. I mean, an expense ratio of 0.03% means that if you invest $1,000, your fees are going to be 30 cents for every $1,000 that you invest, and an expense ratio of 0.09% means that your fees are going to be 90 cents for every $1,000 that you invest. So both very, very little. Now, the reason why I talk about investing in the S&P 500 ETF is because this is a way for you to get general exposure to the stock market. You're just investing in the biggest 500 companies in the stock market, and now if the stock market goes up, your fund will typically go up. If the stock market goes down, your fund will also typically go down. But this is a way for you to grow and compound your money because now you're just investing your money in the market and letting the market do its thing. So if the economy continues to grow and the market continues to grow, well, now your money's growing and compounding because you have exposure to the general market. You're getting exposure to the American economy and the American stock market. And this is one of the most accessible ways to do that because you're just investing in the biggest 500 companies on the market. The second type of ETF that you may want to consider investing your money in is a growth ETF, especially if you have more time on your side, because this is a way for you to get exposure into faster growing companies. Now, faster growing typically also means higher risk, but you also have higher potential for more growth. The reason why you want to have some exposure to growth, especially in this economy, is because, well, our economy is not projected to grow as fast over the next decade and couple decades as it has in the previous decades and the previous generations, just because our economy is so much larger now. Back in the day, in our parents' and our grandparents' generation, we saw our economy grow by 5, 6, 7, 8, even 9% a year. But nowadays, we're just trying to see our economy grow by 2% a year. So our economy, because it's so large, and our country, because it's so large, can't grow as fast as it did before. I mean, when you're a smaller company, it's not uncommon to see your company grow by 20 or 40 or even 100% in a year because you're small and you have the opportunity to gain a lot more market share and you can grow a lot faster. But if you're investing in just the biggest companies, well, you're going to be limited by how fast the economy can grow unless you're really investing in innovation. But if you're already so large, you don't really have the real need to be innovating and creating new products and trying to grow as big as possible, as fast as possible, versus with the growth companies and the growth stocks, these are the companies that are fighting, that are competing, and that are trying to get more market share. So these are the smaller companies that are trying to go faster, but that also means more risk because now that means that these companies also have a bigger chance of failing and not succeeding. So Instead of now you trying to find the right companies to invest in on the growth stage, you can invest in an ETF that will give you exposure to this type of growth. But again, you're going to want to pay attention to these 3 questions, because what you're going to see is that the ETFs that I'm going to go over here are very different than the ETFs that we just talked about that give you exposure to the S&P 500. Now, some of these ETFs are very different from the others, so let's go over them. VB is the Vanguard Small Cap ETF. So this is an ETF that gives you exposure to small cap, smaller capitalization, smaller companies, and you're trying to get more growth here because you're investing in smaller companies that are trying to grow bigger. ARKK is going to be the only actively managed ETF. So this is an ETF that gives you exposure to innovation and is actively managed, not passively managed by a computer. Like the other ETFs that I just talked about is managed by someone named Cathie Wood and her team. She's kind of like a celebrity trader / investor now. And this is an ETF that gives you exposure to more innovation and innovation type of companies. VUG is another Vanguard ETF. This is an ETF that gives you exposure to growth. This is the Vanguard Growth ETF, and this is investing in companies that are trying to grow bigger, faster. And then you have QQQ. This is the Invesco ETF that gives you exposure to the NASDAQ, and this is giving you exposure to the 100 companies, 100 biggest companies that are not financial. And so what that means technically is for most of these companies, they are tech companies, because the biggest 100 companies on the stock market that are not financial tend to be tech. They don't have to be tech, but most of them tend to be tech because besides financial, the next biggest industry of companies are typically in the tech space. And so QQQ gives you exposure to the biggest 100 companies that are not financial. Now, before we get into the questions, got to give you my disclaimer that I do own some shares of the ARK fund. So when we talk about who made these ETFs, this is Vanguard. This is Vanguard, this was ARK by Cathie Wood, and this is Invesco. All of these are very credible investment companies, and to see how much assets they have, let's look into each of their websites. So starting with VB, the small cap ETF on the Vanguard website, it says that they have $141 billion in assets under management. On the ARKK one, it says they have 21,000 million assets under management, which is 21 billion assets under management. The VUG Vanguard Growth ETF has 183 billion assets under management. And QQQ, I'm going to show you this on the finance.yahoo website because it's easier to find here than on their actual Invesco website. But if you look under the net assets number, it says that they have $192 billion in assets under management. So for all 4 of these, we know that they're made by all credible companies, and they all have billions of dollars in assets under management, which is significantly higher than the bare minimum of at least $100 million in assets under management. So we're looking good over here, which brings me here. What do they actually invest in? So starting up here with VB. Remember, VB is an ETF that gives you exposure to small cap companies. By definition, a small cap company is a company that's worth less than $2 billion. So now coming back to the Vanguard website, you'll see that their 10 largest holdings are things like the Biotechny Corp or Pool Corp or Diamondback Energy. Unlike the companies in the S&P 500 ETFs, which are worth hundreds of billions, if not trillions of dollars, those were companies that everyone has heard of. There's a good chance that you haven't heard of any of these companies because they're small cap and these companies are trying to grow. You can compare that to something like ARK, ARKK, which is investing in innovation. Here, this has a very different philosophy where Cathie Wood and her team are trying to invest in innovative companies actively, and they're trying to capture the upside that these innovative companies might have in the future, but it also comes with more risk and more volatility. Take a look. ARK's #1 holding is Tesla. Then their other top holdings are Coinbase and Roku and Zoom and Shopify. Compared to the other passive ETFs, you'll see a lot more changes in the top holdings for ARK because it's actively managed. And so you'll see them change, which is a top holding. They'll buy and sell stocks a lot more often than these because all the other passively managed ETFs are just letting a computer do its thing. VUG is investing in growth companies, but more specifically, large cap growth companies. So this is investing in companies that have a market cap of over $10 billion. That's the definition of a large cap company. It's worth more than $10 billion. Compared to here, this is only investing in small cap companies. VUG's top holdings are companies like Microsoft, Apple, Alphabet, Amazon, Tesla, and Meta, which used to be Facebook. And then you have QQQ investing in the NASDAQ, which are the non-financial companies, and their top holdings are are Apple, Microsoft, Amazon, Alphabet, Facebook, and Tesla. This is from Yahoo Finance. So VB is investing in the small cap companies, the smaller companies. This is investing in the large cap growth companies. This is investing in the NASDAQ, the non-financial companies. And this is investing in innovation. Now that we know what these ETFs are investing in, you got to understand the fees. Going back to the websites, VB's expense ratio is 0.05%, so essentially nothing. ARK's expense ratio is 0.75%, which is a lot higher than the others. VUG's expense ratio is 0.04%, and QQQ's expense ratio is 0.2%. So again, for these passively managed ETFs, the fees are pretty negligible because you're not paying for a person to actively manage and buy and sell the stocks, versus here you can see ARK's expense ratio is significantly higher than all the others. The reason being that this is an actively managed fund, and because of that, you're paying a higher expense ratio, and your goal here is to beat the returns of the market. But again, you're going to see a lot more volatility here. Some years you're going to see great returns. Other years you're going to see much lower returns. You might lose money. And so each one of these has its own fair share of risk, and you got to understand what your goal is before you go and invest your money into any of these ETFs. So now we talked about ETFs that give you exposure to the general economy and the general stock market, the S&P 500 ETF. This is an ETF. The growth ETFs are ETFs that give you exposure to growth and more innovation and more upside, because now you're investing in companies that are smaller, trying to acquire more market share. And then I have one more type of ETF that you want to consider buying. That way you can grow and compound your wealth. The third kind of ETF that I want you to consider investing your money in to grow and compound your wealth are emerging market ETFs. These are ETFs that invest in companies overseas and outside of the United States. That way now you can get exposure not just to different companies, but different countries around the world. That way now if the United States economy slows down, or if the United States dollar has issues, or something happens to the United States, you're not out of luck completely, because now you're investing in countries outside of the United States that have their own economies, their own governments, their own systems, and now you're getting exposure to something completely outside of the United States. Now again, this also has its own fair share of risks, because a lot of these countries, especially the emerging markets, might not have as much stability as the United States. But the whole idea here is you're investing in a growing country. So if this country can grow a whole lot bigger, their economy can grow a whole lot bigger, and you're invested in a strong company, well now this company can see a whole lot more upside, because the whole country and the whole economy there is starting to grow. And yeah, the risk is that some of these emerging markets like China rely on the United States to spend a lot of money in that country. But if these countries continue to grow, now you're also getting exposure to different countries and different economies, which is something important for you to consider, because you have a lot of countries and a lot of economies outside the United States that are growing significantly faster than the United States economy, just because the United States economy is so large. It just can't grow as fast as they used to. And so these emerging market ETFs gave you exposure to that. Now, before I go into the specific emerging market ETFs, one thing that I do want to mention is that no matter which ETFs that you're investing in, the key for any ETF strategy to work is you have to keep consistently investing your money in ETFs, and you want to do this automatically. This way every week or every month, money is automatically leaving your account and going into these ETFs. And this is something that you want to keep doing whether the market is up or down. The key for this to work is you have to be consistent. You don't want to just put your money in once and just forget about it. You want to keep putting your money in and letting your shares in this ETF grow, because now you're just getting exposure to the different markets, the different stocks, the different companies, and you're just going to keep acquiring shares and let the companies do their thing. And I forgot to mention this just a second ago, but the last key to really make this passive investing strategy work is you have to give it time. The key for this to work is you have to invest your money consistently, passively, and let your money grow and compound, which means you're just going to let your money sit there and continue growing and building on top of it, because your investments need time to appreciate. So a few different emerging market ETFs that you may want to consider looking at are VWO. This is a Vanguard emerging market ETF. EEM, this is an iShares emerging market ETF, and SCHE, this is a Schwab emerging market ETF. Now again, disclaimer, I have my own money invested in VWO and SCHE. So now let's dissect and analyze these three ETFs. The first thing is who made it. We have Vanguard, we have iShares, and we have Schwab. All of them are, again, very reputable and very credible companies that made these ETFs. So let's go a little bit deeper and see the assets under management. Starting with VWO, it says that the fund total net assets are $110 billion. Moving on to SCHE, the Schwab ETF, it says that the total net assets are $9 billion. And then the iShares EEM Emerging Market Fund says that the net assets are $28 billion. So again, each one of them passed this test. It's a credible company and they have a large number of assets under management, each one in the multiple billions. The second question, which is even more important here, is what do they invest in? Now, not only are you looking at the companies, but also what kind of company and which countries are these ETFs investing in. See, it's one thing to be investing into a small cap company in the United States. You know that the United States economy is stable, so when you're investing in a small cap company in the United States, it has its own fair share of risk. You're just hoping that this company, which is small, will be able to grow in the stable economy. But now when you look at these emerging markets, now these economies and governments aren't always as stable as the United States, depending on which country that you're investing in. And so a small cap company in an emerging market might have a much harder time growing, or it'll have the possibility to grow significantly larger depending on which country it's in. So this is where you have to be a little bit more picky and know really what your risk tolerance is, because a small cap company in an emerging market is riskier than an investment in a small cap company in the United States, just because of the stability of the economy. This is where you have to know your risk tolerance, and you got to know why you're investing your money. Are you looking to invest your money into emerging markets just to get some diversification in your portfolio, or are you looking at investing in emerging markets that way you can see a whole bunch of potential upside by investing in these growth companies in emerging markets, which could try to take over and become a leading company worldwide starting in emerging market? So let me start by analyzing VWO, the Vanguard Emerging Market Fund. If you scroll down onto the Vanguard page, you'll see the portfolio composition, and you'll see that 99.5% of this ETF is investing in emerging markets, 0.4% is in Europe, and 0.1% is other. And you can look at some of the largest holdings. The number one holding is the Taiwan Semiconductor Manufacturing Company, number two is Tencent, number three is Alibaba, and on and on and on. But you also want to take a look at the countries that it's invested in. So if you come back up and click on the portfolio and management tab, and then you scroll down, you'll see the market allocation of the top countries that it invests in. So the top 5 countries that this ETF invests in are China, followed by Taiwan, followed by India, Brazil, and South Africa. Now I want to remind you that with these type of emerging market ETFs, your risks are different than with just investing your money in a US company. And so now you can see bigger swings in these ETFs and in these companies than you would typically see in a US company. VWO has investments in over 5,000 companies, and you can compare that to EEM, which has investments to about 800 or so companies. And these are companies which are large or mid-cap companies in emerging markets. So if we come down to the holdings section in this ETF, you're going to see that its top holdings are actually similar to the Vanguard fund. The number one in this is the Taiwan Semiconductor Company, then you have Tencent, then you have Samsung, then you have Alibaba. And then if you scroll down a little bit further, you'll see the exposure breakdowns, and then if you click the geography tab, you'll see the top countries that this ETF invests in. So the top countries for this ETF are number one China, then Taiwan, then South Korea, then India, then Brazil. So you can start to see why this question is so important here, because yeah, they do have some similar companies that they invest in, and some similar countries, but they do have different countries, meaning different companies that they also invest in. And this brings us here to the Schwab ETF. So similarly, the Schwab ETF is investing in large and mid-cap companies in emerging markets. It's investing in about 20 or so countries overseas, and we can take a look at some of its top holdings. Under the portfolio tab, you can see the top holdings, which are for here, the Taiwan Semiconductor Company, you have Tencent again, Alibaba again, and then you have companies like Meituan, I think that's how you say it, and Reliance. And then scrolling down to the countries, you'll see that the top countries that this ETF invests in are China, Taiwan, India, Brazil, and South Africa. And now that you know where these ETFs are making their investments, you got to understand the fees. That way you know that you're not overpaying in fees to invest in some countries or companies. So starting with the Vanguard VWO ETF, the expense ratio is 0.1%. Then the iShares EEM ETF, the expense ratio is 0.7%. And then you have the Schwab SCHE ETF, which has an expense ratio of 0.11%. So comparatively, this and this ETF have significantly lower expense ratios than this ETF. So you just got to do your research and see if this expense ratio is worth it for you if you want to invest in emerging markets. So there's 3 different ways of investing, growing, and compounding your money. The first is by investing your money into the S&P 500, which gives you general exposure to the economy and the stock market. Then we have the growth stocks. These are the companies that are fighting to grow bigger, and these are a little bit riskier, but you have a lot more upside with your growth stocks if these growth ETFs ETFs can grow bigger and the companies within those ETFs can acquire more market share. And then we have the emerging markets. Not only here is it a hedge against the United States, but it's also a way for you to see more potential upside, again, more potential risk here, because you have countries around the world that are trying to grow a lot bigger. They have a lot more potential upside, which means the companies which are innovating and growing within those countries also have the potential for more upside. But the key, again, for any of this to work is you have to keep consistently investing your money. You have to automatically invest your money, and you want to make sure that you let your money invest and grow and compound over time, because this is a long-term play. These are not trading strategies. This is a way for you to build wealth and continually keep investing your money and slowly let your money grow and compound over time. If you want to become wealthy or financially free, the first thing you got to do is right now, you need to start investing a minimum of 15% of every dollar that you earn. If I told you that I am budgeting my money right now, that way I can live off of $7,000 a year, you're probably going to think that I'm never going to eat guacamole again, or I'm going to live in a box, or I'm going to move to a third world country. But here's the thing, about 50 years ago, if you were living off of $7,000 a year, you'd be living pretty decent. I mean, $7,000 a year 50 years ago is like $50,000 a year today. This is where people think about building wealth and retirement and financial freedom all wrong, because people always talk about, okay, when I become financially free, my goal is to be able to live off of $50,000 a year. But your $50,000 a year that you're thinking of is today's money. $50,000 a year today is very different than $50,000 a year 50 years from now. Just like how $7,000 a year today is very different than what $7,000 a year was back 50 years ago. So when we're talking about building wealth and investing your money for retirement or this financial freedom or whatever you want to call it, you got to understand two things. One, you got to understand how your money works, that way you're using the money right way. And then second, you got to know how to invest this 15% and why you need to be investing this 15%. But before I get into that, I need you to do me a quick favor and smash that thumbs up button below, because the way the YouTube algorithm works, if you do not smash that thumbs up button, then YouTube is much less likely to show you and other people our financial news and education videos. When the majority of people think of money, they relate it to stuff. How much stuff can my money buy me? If I make $1,000, what is this $1,000 worth? If you ask the majority of people, you relate $1,000 to how many nights can I go out, how many vacations can I go on, how many nice clothes can I buy, how many times can I buy extra guac. So the majority of people, when you think about money, is what stuff can I buy? The reason we call ourselves the minority mindset is because we think differently than the majority of people. When I want you to think about money, I want you to think about money in terms of how many assets can you buy. An asset is something that makes you money. And so now when you have $1,000 or $10,000 or $100,000, I want you to ask yourself, okay, now that I have this cash, how many assets, investments can I buy, which are things that are gonna make you more money? When I was younger and I made money, the question that I had was, how can I use this money to improve my car? I started by tinting my windows, and I got new rims, then I got subwoofers put in, then I got all this other stuff put in, and it was always this kind of like balance of, okay, I made $1,000, what can I do to my car? Ooh, I made $2,000, how can I upgrade my car? So anytime I made money before, it was, how can I spend this money in a way that's gonna better my car or whatever I have? This completely changed when I started investing in real estate, because after I bought my first real estate investment property, it was making me something like $250 a month in profit every single month. And once I got it up and running and going, it was $250 a month passively, which means I wasn't doing any work. Every month, $250 was being deposited into my account. Now, all of a sudden, the way I thought about money completely changed, because now I'm thinking in terms of houses and real estate instead of cars. Because now in my mind, I'm thinking, okay, if I can make $250 a month from one property, that means from two properties, I could make $500 a month. With 10 properties, I can make $2,500 a month. With 100 properties, I can make $25,000 a month every single month passively without me having to do any work. As you grow, you'll start to realize that there's easier ways to do this. Like you might not have to buy 100 single family homes. Maybe you can buy an apartment complex, and some properties are gonna pay you more per unit than others. But in general, that mindset is true. Now I'm thinking about assets instead of liabilities. I'm thinking, okay, when I make money, what investments can I buy? What assets can I buy? How can I use my money to make myself wealthier? How can I use my money to build more assets? How can I use my money to create more value instead of just using my money to spend on nice things. You want to have your nice things, I understand that. But when you make money, I want you to think about it in terms of assets instead of liabilities first. Once you start changing the way you look at money, it is going to be so much easier for you to start investing your money and put more money aside to investing, because before, putting this money aside was a chore, because now you are sacrificing a nicer car, you are sacrificing another vacation, you are sacrificing all these nice things, but now you're not making that sacrifice. Now you're working more towards your goals of buying more assets, because that's the way you're looking at money. Now you look at money as a tool to buy you more assets, which allow you to have nicer things. But now when you change the way you look at it, it's easier for you to make more of these sacrifices to buy more assets. That way you can have more freedom, have more wealth, and then ultimately have more of the nice things, the nicer cars, and nicer vacations. Now let's get into the numbers, because if you're subscribed to our channel, chances are you've heard me talk about our 75-15-10 plan, which says for every dollar that you earn, 15 cents is the minimum you should be investing, 10 cents is the minimum you should be saving, and 75 cents is the maximum you should be spending. Now I'm going to go over that 15% investing, why 15%, and what the numbers actually look like when it comes to building your wealth. Here's the thing. Investing is the real secret to building wealth for regular people. It is not building the next Amazon. It is not finding the next hot stock before it pops. It is not winning the lottery. It's not having a job that pays you $1 million a year. Yes, these things can help, but they are the exception to the rule. They're not the rule. So if you really want to build wealth, the secret is investing your money. And the issue here is so many people are not doing this, even though I think we should know this by now. It's hard because on one hand, we're never taught about money. Like, we don't go to school learning about how money works, how budgeting works, how investing works, how to build wealth. And on the second side, we just don't really have kind of a good financial culture when it comes to spending, because we live in this debt culture where it is completely normal to finance your wardrobe. And so this is kind of the culture that we live in. And the only kind of financial education that people get nowadays is you go to your job, and then your job gives you this packet which says, here's your 401k information. That's why right now, half of America is not investing any money. Not a single penny at all. And on top of that, the people that are investing, most of them are only investing their money in their 401k, even though your 401k was never intended to be your sole retirement or investment plan. So if we kind of diagram this out, if this pie represents America, that's a very lopsided pie. If this pie represents America, only half of these people, so these people are not investing any money. Only half of these people are investing any money at all. Now, out of these people that are investing any money, the majority of these people, so something like this, are investing their money only in their 401k. This is the only people that are investing their money in their 401k and out of their 401k. These are the only people that are creating their own wealth and retirement outside of what's kind of just given to you. Out of these people that are only investing their money in their 401k, which was never intended to be your sole retirement or wealth building or investment tool, out of these people, the average 401k contribution is just 7% of your income. So you have a huge chunk of Americans that are not investing any money. And then you have this big chunk of people that are investing their money, but they're only investing their money in their 401k, and the average contribution is just 7%, which means you have only a few percentage of Americans that are investing more than 7% of their income every single year towards their wealth, towards their retirement, towards their financial freedom. If you really want to become wealthy, you got to invest more than 7% of what you're making. Now, let me show you why investing a minimum of 15% of your income is so important. Let's assume that now when you're 21 years old, you go out and you get a job paying you just $30,000 a year. So you are making $30,000 a year, and let's assume that you're investing 15% of your income every single year before taxes. So that means you are investing right around $4,500. So I'm also going to assume that you're working a job where your salary is going to grow over time, and let's assume that your salary just grows by an average of 3% a year. Now, I know over time, hopefully, your salary will grow by more than this, but let's assume just 3% a year, because sometimes you're going to get a raise, sometimes you're going to go to a new job, maybe you'll get another bump there, maybe you get a promotion, but every single year you get a 3% annual bump, and as you continue to make more money, you continue to invest just 15% of your income. If you do that between the age of 21 and 65, you are going to save, so at 65, you continue to do this, you are going to put aside $400,000 over these 44 years. Now, if you just save this cash and you started living off of, let's say, $30,000 a year, then this $400,000 would last you about 13 years. After 13 years, this $400,000 would go away, but you also got to remember that this is $400,000 about 44 years from now. This $30,000 a year in 44 years is not going to have the same value as $30,000 today. I mean, by the time you're 65, if you continue to grow your income by 3% a year, you're going to be making more than $100,000 a year. So if you want to continue maintaining your lifestyle at 65, that means you got to pull out $100,000 a year here. So your money's only going to last you 4 years. By the time you're 70, you're going to be broke. So this saving model doesn't work, which is why I want you to invest this 15% a year. If you invested this 15% a year and this $400,000 went into your investments and you got a below average return for the course of your life and you only got a 4% annual return on your money. If you were able to get a 4% average return on your money over your lifetime, then this $400,000 will grow to right around $900,000. Quite a bit more, but you got to remember, this is still quite a bit below average. If you got an average return of 7% a year, then this $400,000 you invested over your time would grow to $1.9 million on the side for you to now use however you want. And if you could grow your money by 10% a year, which is just a little bit above average, especially when you account for inflation, then your money would not grow to $1.9 million, it will grow to $4.8 million. But the only way this is going to happen is if you're investing 15% of your income every single year. Now look, this is where you got to really understand money, because so many people make this mistake that when they're planning for wealth or retirement or financial freedom, they're thinking in today's dollars. They're thinking, okay, I'm young today. I'm hoping that I can live off of $30,000 a year or $50,000 a year or $100,000 a year, because they're relating that to today's money. But $30,000 a year today is not going to be the same as $30,000 a year 45 years from now. That's why your income is hopefully going to be adjusted with inflation and go up by a couple percent or a few percent a year. If you are 21 today and you're making $30,000 a year, by the time you're 65, if your income grows by 3% a year, you're going to be making something like $106,000 a year by the time you're 65. So if we assume that $106,000 is what it takes for you to keep the same lifestyle at 65 as you do in 21, that means you got to be pulling out $100,000 a year when it comes time for you to retire in order to keep the same lifestyle that you have today. Now, depending on how much money you're making, that might seem like a whole lot of money or not enough money, but what you got to understand is that in 45 years, $100,000 a year is not going to be as much as $100,000 a year today. So you got to kind of plan for that with your money. And so if we're looking at this kind of income and you're thinking, all right, if I want to maintain my lifestyle, I got to be pulling out $100,000 a year. If you have $400,000 sitting there, that's not going to cut it. You're not going to have a very nice retirement or financial freedom, because after a few years, you're broke. Now here, if you get the 4% a year, now at least you have some more money. And what you got to also understand is, because this money is invested, you're hopefully going to continue growing it after you start pulling money out too, because you're not going to pull out all $900,000 at once, at least hopefully not. You're going to pull out $100,000, let the other money grow, pull out another $100,000, let the other money grow, and kind of go on like that. That way this can last you more than 9 years. And here, assuming you can just get an average return, now you really have money put aside for the rest of your life, because now you got money for at least the next 20 years. Because even if you're pulling out $100,000 at a time, that means you have your money growing for another 18 years after you pull this money out. So you pull out $100,000, your money continues to grow the next year, because you only pulled out $100,000, you still got $1.8 million in there. Then the next year you pull out another $100,000, you have $1.7 million growing for you. So as long as you got money in the account, your money will continue to hopefully grow. I want you to be an aggressive investor. Actually, I need you to be an aggressive investor, because Social Security is becoming a thing of the past and pensions are becoming history. And so if you want to be able to take care of yourself and take care of your wealth and take care of your family and your finances, you got to be the one to put it in place, and you got to be the one to start taking action, because you cannot rely on the government to take care of you, because the government national debt is skyrocketing. They have their own problems. It is very hard and very painful to rely on somebody else, especially the government, to take care of you, which is why I want you to be an aggressive investor. That way you can take care of yourself and take care of your wealth. That way you can live your life the way you want, not worrying about what the government's going to give you. Now, there are different ways that you can invest your money. That way you don't have to actually sell your assets in order to have have money in your hand. Like if you invest in rental properties, investment real estate, now you're creating passive income cash flow. That way you can get cash in your hand every single month without you having to actually sell a property. And if you're investing in dividend paying stocks, now you're making money every quarter or every year from your stocks, and you don't have to actually sell your stocks to get paid. But I'll get to that in just a second. Now here's the thing, most people don't start investing their money as soon as they turn 21. What you need to understand is the older you are, the more aggressively that you need to invest. Just because you're older and haven't started yet doesn't mean that you can't start. It just means you got to be a little bit more aggressive. There's in general two different ways that you can invest your money. You have one way of investing your money, which is through retirement accounts. This is through things like a 401k or an IRA. And then the second way that you can invest your money is through non-retirement accounts. This is through creating your own stock brokerage account and investing your money in stocks, or through investing your money in physical real estate, not through a retirement account. And so this is money you're not doing in a retirement account, versus retirement accounts, they can give you some tax benefits. The whole purpose of a retirement account is literally to help fund your retirement, because when you invest your money in these accounts, you can kind of get a tax deferral right now, and then your money can grow tax-free until it comes time for you to retire. Unless you use a Roth, then you're paying taxes today, and then you don't got to worry about taxes when it comes time for you to pull your money out. I'm not going to get into too many details on this, but the whole purpose of this is for you to invest your money. That way it can grow tax-free, but you cannot touch your money until it comes time for you to retire. If you want to learn more about that, I will link a video where I've already discussed this in the description below. The point that I'm trying to hammer home here is your retirement accounts are typically not enough, because your 401k and IRA has limits, and you got to make sure now that you're not investing your money based off of what the government limits you at. You got to be investing your money based off of the way you want to live your life in retirement. That's why I say a minimum of 15% of your money needs to go towards your investments. Some of that money can go towards your retirement accounts, but if that's not hitting the 15%, then you got to be investing your money on your own too. That means maybe you got to create your own stock brokerage account, or maybe you got to start investing in your own physical real estate. That way you can get passive income. But here, you got to know what your goal is first. If you want to see your money grow quickly and you don't mind taking on more risk, then you should consider investing your money in the stock market, especially in growth companies and these kind of more startup companies, where these companies are trying to grow as quick as possible, as fast as possible. There's more risk involved because startup companies can fail and they might not work out, but you have the opportunity to see your money grow a whole lot quicker, because these are companies that are working really hard to grow as big as possible and as fast as possible. If you just want to see slow and steady growth in your money, then you can look at investing your money in more blue chip companies. These blue chip companies are your bigger established companies that have already been there for a long time. They already have their systems, and you're just investing your money in this company. That way you can see your money grow slowly. The advantage with this is you have less risk, because these companies are already established. You already know how they're making money, and you can kind of reasonably predict how much money they're going to make and how fast they're going to grow. So you have less risk, and so you get lower potential returns. One thing that I do want to mention about investing your money in the stock market is that the stock picking game is not for most people, because picking stocks requires a lot of work, a lot of research, and a lot of upkeep. If you're not willing to do that, then instead of investing your money in individual companies, like trying to find the next Amazon or Google or Facebook, then what you can do is invest in something called a fund, like an index fund or an ETF, because these funds give you exposure to a whole bunch of different companies, and so you have less risk, you can put in less work, but now you're kind of growing with the stock market. I already made a video where I talked about that, so if you want to learn more about how to do that, I will link it for you in the description below. If you're looking for income, where now you can create cash flow or passive income coming into your account every month or every year, where now you can have money in your hands without selling your assets, then you want to be investing your money in things like dividend paying stocks, because dividend paying stocks typically pay you a check every 3 months. Or you can invest your money in real estate, because now if you own a house or you own an apartment complex, now every single month the people that are living in your real estate or using your real estate have to pay you rent every single month, because they're using your asset. So now when you own these assets like a dividend paying stock or rental properties, now you're making money consistently without you having to physically sell your asset. Real estate is also a really good store for your money, because if you have a lot of cash and you want to put it somewhere safe, then real estate is a good place to do it, because now you own something physical and tangible that you can see, feel, and touch, and that's creating income. Now I know real estate prices don't always go up. You could see a real estate crash, but in general, if you own a property in a good area, then you own something that people need, that something want, and that you can see, feel, and touch. The key for any of this to work though is you got to be consistent, and you got to keep investing your money, because investing is not a one-time thing. It's not like you can just take $10,000 and throw it in the market, or go out and buy one investment property and say, all right, I'm done investing now. It doesn't work like that. You gotta keep investing your money consistently if you want to continue to build your wealth. Yes, if you see a market crash, then come and buy as much as you can then, because that gives you the opportunity to buy assets for pennies on the dollar. But in general, you gotta keep consistently investing if you want to build this wealth, because you gotta keep putting more and more money towards your investments. Now, for a lot of people, they don't want to be in the game of trying to find the best companies and do the research and find the best time to come in and buy, which is why I say do it every time you get paid. Just create a system. Anytime you get a paycheck, 15% of that should be automatically invested. That way it kind of happens without you having to think about it, and that way you don't accidentally spend this money. There are apps out there that can automate this whole process for you. That way anytime you get paid, a portion of your paycheck will automatically be invested into whatever funds or stocks that you want it to go to. That way your money is constantly just going out without you even seeing it, and that way you're not even tempted to touch your money. Building wealth is really a game where you got to juggle time and how much money you have to invest, because the more time that you have on your side, the more your wealth can compound and the bigger your wealth can grow. And the more money you have to invest, the faster that you can grow your wealth. But the tricky thing about this, if you look at it practically, is most of us make more money when we're 50 or 60 than we do when we're 21. And so you kind of get more of your money towards the end of your career, but you have more time in the early part of your career, which is why you got to balance it out. You got to start investing aggressively early. That way you can put more money and have the time on your side. That way you can kind of grow your money and have more money working for you. And as you start to make more money, you continue to keep investing 15% of your income month after month after month. That way you can continue to compound that wealth and continue to keep growing your money. Again, don't take what I'm saying as the ceiling. I want this to be the floor, because right now the average person is investing nothing or very little. I want you to kind of up the minimum and make it so you're investing a minimum of 15% of what you make. Once you get the hang of that, then up it up 20%, maybe 25%, depending on what you're making. The more you can invest, the faster you can build that wealth. And the faster you can build this wealth, the more assets and income that you'll have. That way you can live the life you want without worrying about the price, because you got your assets producing income, which can fund and buy you whatever it is you want. If you want to save some money quickly, but you don't want to feel like you're cutting back on having fun and living your life, make sure you watch this video until the end, because I'm going to be going over 10 ways that you can save $1,000 quickly. Americans are not saving enough money. Just 40% of Americans have the means to protect them from an emergency like a leaky roof or needing to replace their tires, which means 60% of Americans, the majority of America, does not have the cash necessary to protect them from a leaky roof or having to replace the car tires without going into credit card debt or having to go to the bank and having to borrow money. Now, there's a lot more to becoming wealthy than just living smaller and cutting back expenses and saving your money and being cheap. I actually just made a video on YouTube where I talked about if being cheap can make you rich. So if you want to learn more about that, I will link that video for you in the description below and also for you up here. But you got to know how to take that first step. That way you can build your financial base. That way you can have some cash in the bank. And you know what? It really doesn't have to be as burdensome as just never spending any money and never having any fun if you know how to save your money the right way, which is why in this video, I'm going to be going over 10 ways that you can save $1,000 quickly. But before we get into that, I need you to do me a quick favor and smash that thumbs up button below, because the way the YouTube algorithm works, if you do not smash that thumbs up button, then YouTube is much less likely to show you and other people our financial news and education videos. And I'm going to start by talking about why you need to review your bills. I'm a gym person. I love working out, and my gym membership costs me $70 a month to work out at my gym. But I noticed on my credit card statements that my gym membership wasn't charging me $70 a month. They were charging me $75 a month. And so I got kind of curious, what is this extra $5 for? So I called up the gym, and they said that they signed me up for a magazine that I never knew that I signed up for, and that's why they were charging me an extra $5 a month. Now, I've had my gym membership for years, and I'll probably continue to have my gym membership for many years into the future, and they were just slapping on this $5 fee because they probably thought no one's gonna check their bills. Now, an extra $5 a month isn't really gonna change my life. I mean, maybe I guess I could afford another side of extra guac, but I'll get to that in a little bit. The whole idea here is you gotta figure out what you need, and you gotta see what you're paying for. Chances are, if you pull out your credit card statement and you go through all of your bills, you're gonna find that you have subscription services that you do not need anymore, and you're gonna find that you're paying for things that you don't use. The simplest way that you can start saving some money is just stop paying for the things that you're not using anymore, because chances are you're paying for something that you're not even using. And when it comes to the things that you are using, like your gym membership, make sure you're only paying for what you use. Like if you got a gym membership, make sure you're only paying for the gym membership and not some magazine that you've never read in your life. Second,
Second, you gotta know the true cost of what you're buying. If you go to the mall and you buy yourself a nice $150 jacket, what is the true cost of your jacket? So many of you might be thinking at this point that if you bought a $150 jacket, the true cost is $150. But that's not the full story. Yeah, you paid $150, but I want you to really know what it cost you to get the $150. So let's say you make $20 an hour. So if you make $20 an hour, how long did it take you to make this $150? That would be what, 5, 6, 7, 7.5 hours of work to get this $150 jacket. But this is actually before taxes, because remember, Uncle Sam's got to take their cut with the IRS. So after taxes, it's actually going to cost you 9.5 hours of time to buy this jacket. Would you rather have the jacket, or would you rather have 9.5 hours of time? This is almost always one of the first calculations I have in my mind, because I always want to know, how much time is this thing going to cost me that I want to buy? Now, I get it. You can have passive investments that pay you without you having to physically work, but you got to know how much your time is worth. And if you know that, then you can calculate how much time this thing is going to cost you. And then you can really ask yourself, do I want to spend this money on this jacket? So now you know that the true cost of your jacket isn't just $150. It's almost 10 hours of your time. But the second thing you need to ask yourself when it comes to the true cost is, what would this jacket be worth in the future if you didn't buy a jacket? Because what I want to know is, if I didn't buy this jacket and I invested this money, what would this money have become? Because if I invested the $150, this $150 in 10 years would be worth not $150, but $300. And in 20 years, this money that I would have spent on my jacket wouldn't be $150. It would be about $600. And in 30 years, this $150 that I spent on my jacket would have become more than $1.1 thousand if I had just invested the money. So now, the real cost of this jacket isn't $150. It is almost 10 hours of my time, and it is the opportunity to make $1,100 over the next 30 years. Now you can ask yourself, do I really want to spend $150 on a jacket now? Too late, I already got it, Jaspreet. One of the easiest ways to save money quickly is just to not spend our money. But the tough part about that is, when we want something, we want it right now. And so what I want you to do is just take a step back before you go out and you buy that jacket on impulse, or before you go and you buy something that you don't need. Just take a step back and ask yourself, what is the true cost? How much time would it cost you to actually get that? And how much money is this going to cost you over the long run? Once you do that, I want you to follow the 24-hour rule, which says you want to buy something, great. Now just take a step back, wait 24 hours, and then decide if you really want to buy it. If you still want to buy it and you do these calculations, then go out and buy it. But if after those 24 hours, you thought about how much time it's going to cost you, and you thought of how much money you're losing out of in the future, and now you decided not to buy it, well, now you just saved some cash by not spending it. Third, let's talk about eating out and drinking out, because there's a huge debate in the financial world about coffee. You have people like Susie Orman who say that you going out and drinking Starbucks is one of the dumbest things that you can do with your money. And then you have people like Ramit Sethi who say the opposite. He says that it doesn't matter if you spend $5 at Starbucks, because $5 is just $5. It's not going to make a difference. Now, honestly, I can't relate to any of that, because I don't like coffee. Coffee tastes like poo-poo. I don't drink coffee. I drink tea. If you go out to Costco and you buy their big pack of green tea, it's gonna cost you something like 24 cents to drink one glass of tea. Now, personally, I'm a big fan of nice teas, because there's a difference between your kind of lower quality teas and your nicer teas. If you want a nice cup of tea, it is going to cost you somewhere between 35 cents to 50 cents if you make it at home. If you go out and you buy the same tea from a nice tea shop, it is going to cost you at a very minimum of $3.50. So clearly, if you went out and you made your tea yourself, you're going to save $3 every time you make your tea at home. But let's also talk about the food. If you're subscribed to our YouTube channel, you know that I love food, and more specifically, you know that I love guac. Now, if I go out and I go to Target and I buy an avocado right now, it is going to cost me something like 89 cents. Okay, if I go out and I buy this avocado, so I'm gonna draw you an avocado that looks more like a cookie than an avocado, but if I paid 89 cents for this avocado, I can make 4 sides of guac. Okay, now if you're like me and you really like guac,
Maybe this is just gonna make you one side, one avocado, one side, but let's assume that you can make 4 sides of guac from this one avocado. That means if you eat your guac at home, you are gonna be paying somewhere between 25 cents, I'm gonna round up here, to 89 cents for your side of guac. 89 cents if you're someone like me who wants to eat the whole avocado, 25 cents if you only wanna eat a fourth of that. Okay, you're gonna be paying less than $1 if you wanna get your guac, but if you go to the store, if you go to a restaurant and you wanna get a side of guac, it is gonna cost you at least $3 for a small side of guac, and you're barely gonna get a quarter's worth of guacamole. If you just make your nice tea at home, and I don't know about coffee, but tea is very easy to make at home. All you gotta do is warm up some water and put some tea leaves in there or put a tea packet in there. It is very easy. You don't need any fancy equipment. So if you just make your tea at home and you eat your avocado at home, you're gonna save $6 between the two. Now, if you do this 5 times a week, like many people do, 52 weeks a year, you are going to save $1,500 over the course of a year just by eating your avocados at home and just by making your tea at home. This is where I want to give you a little disclaimer, because you know what? I like tea, and sometimes I do like drinking in a tea shop. I'm not one of those people who says, I never go out to the tea shop and drink tea. I like to have a lot of meetings over tea. I don't go to the bar, I don't drink, I don't do things like that, but I do like tea. And I have a lot of meetings over tea. So sometimes for the experience, I will go out and I will drink this tea. But when it comes to my daily tea, I don't drink tea every single day, but when it comes to my regular general tea, then I'm just gonna make it at home, and I'm not going to the tea shop every morning to get my morning tea. This is where I want you to draw a line between consumption and enjoyment. If you're just going to the tea shop every morning to drink your tea and you're just putting extra guac in your lunch because you like guacamole, you are blowing money on things that you don't need. But if you're going out to hang out with your friends because you want to drink some tea together and have a good time, sure, go out and pay $3.50 for a tea. That's okay. But spending this money every single morning just because you don't want to brew it at home, that's a different story. It is okay to go out and have a cup of tea with your friends or go out to a restaurant once in a while, but it is different when you're talking about doing it every single day just because that's what you think is normal, because you want to go out and you want to eat a burrito and you want to get extra guac every single day. By the way, if you are eating in restaurants, just drink water. You are going to save a ton of money just by drinking water instead of ordering a Coke. One thing that I learned growing up in the Indian household is that everything is negotiable. If you're in India and you go out and you buy yourself some apples, you're going to negotiate the price of that. If you go out and you buy yourself a new shirt, you're going to negotiate the price of that. Okay? Almost everything is negotiable if you ask. Worst case, they just tell you no. One of the simplest and least painful ways to spend less money every single month is just to negotiate your bills lower. So what I want you to do is start by taking all of your utility bills. So your cable bill, your internet bill, your phone bills. Take these bills and now look at what your competitors are charging. Chances are that the competitors to the companies you have some lower introductory rates out there right now. Now what I want you to do is try to get the bill that you're paying right now down to your competitors' lower introductory rates. That way you're getting the same service at a lower price, so you're literally just saving money for doing nothing except making a 15-minute phone call. The way you do that is you're gonna call up the customer service number on your statement and they're gonna say, "Hi, I was wondering if there's anything you could do about my bill because I feel like it's really high." Now, they're gonna say either yes, we can bring it down a little bit, or they're gonna say no, there's nothing we can do. No matter what they say, even if they agree to lower your bill, I want you to push them lower. What you're gonna say is, "Oh, really? Okay, I saw that your competitor so-and-so was charging only $25 a month. Is there any way you can match or beat that? I'd really like to stay with your company." Now what you just did is you suddenly put it in their head that you are considering leaving because their competitor is charging a lower fee. No company wants to lose a good paying customer to their competitor, especially if you've been there for a long time. So now what they're going to do is they're going to seriously see if they can bring your bill lower. If they don't bring your bill lower, or they don't bring it low enough, that's when you want to ask to speak with the manager, because managers typically have more negotiating room. The key here for any of this to work is you need to be nice, because customer service agents are getting yelled at all day long by people complaining about their bills. If you are nice to them, they will be nice to you. This should go for any big purchase you want to make. Your home, even if you're leasing your home, you can negotiate the price of your lease. Your car, anytime you make a big purchase, make sure you negotiate it first. Fifth, I want you to move your savings. And that means two different things. As soon as you get paid, I want you to automatically move some money from your checking account, where your money goes into, to a savings account. That way you can't accidentally spend the money, because sometimes we feel that if we have cash in the bank, we should spend it. Well, if that money automatically leaves before you can touch it, now you're not going to have the urge to spend it, because you're not going to see that money. So anytime you get paid, you need to automatically move some of your money to a savings account. That way you can't accidentally spend it on a new TV. Second, I want you to consider moving your savings account to an online bank that pays you a higher interest rate than a traditional bank, because if your money is saved at a traditional bank, chances are they're paying you next to nothing. If you move your money to an online bank, you should be able to get a much better return, because online banks have lower fees. They don't have the same overhead and all the rent costs, because they don't have those retail banks everywhere. So because they have lower fees, they can pay you a higher interest. Now, this higher interest is not going to substitute an investment, and it's not going to make you rich. But if you're saving your money anyways, you might as well get a better return on your savings. That's what I do with my savings. I know that my savings are not doing anything except sitting there collecting dust, so I move my savings to an online bank. That way I can at least get some interest and get some money for my savings, because it's just sitting there doing nothing anyways. And if you do want to learn more about how you can save your money and get a better return at an online bank, our team has written an article on this on our website, theminority-mindset.com, and I'll also link this article for you up here and in the description below. Sixth, I need you to start shopping around for the right things, because when I say shop around, I don't mean shopping around for a new Gucci scarf. I mean shopping around for the services that you can save some money on. Your insurance, so this is your health insurance, your home insurance, your car insurance, all the different insurances that you have, your phone bill, your cable bill, and your internet bill. I need you to shop around for these four things every single year, because chances are these companies are going to raise your bill every single year, and so you want to make sure you're getting the best rate, because if you just stick with one company because you don't want to shop around, you are going to get ripped off. So every year I want you to spend just half an hour shopping around. That way you can make sure you're getting the best deal possible. You can even negotiate the price of your bill lower, like I just talked about, but you want to make sure that you're not overpaying, because this is a simple way to save a ton of money. Seventh, we all have things that are sitting there in a house that aren't doing anything. Like when I graduated law school, I had a ton of books in my room that were just taking up space and collecting dust. So I went out and I sold a bunch of my textbooks, and I made like $400 just selling the textbooks that were doing nothing except taking up space. We all have things in our homes that we're not using, that are just taking up space and collecting dust. What I want you to do is take the things that you do not need and take them and sell them. Your kids' clothes, your old furniture, your old phone, your old TV, your old electronics, all these things have some value, and you can go out and you can turn these old things that are collecting dust into some cash if you just spend the time to go out and sell them. 8, pay your stuff on time. So this is one of my pet peeves. I cannot stand paying late fees, because when you pay for a late fee, you are paying for something that you're getting no value for. Like when you pay a $25 late fee, you are getting no extra value. You just forgot to pay the bill. And Americans on average are paying $250 a year in late fees alone. That's $250 that you're spending on something that's giving you no value and no return. If you just want to throw your money in the garbage, you might as well just mail it to me. Avoid paying late fees at all costs. Put it in your calendar, use auto pay, set reminders, do whatever you gotta do. That way you don't have to pay a $25 late fee. 9, you can use technology to help you save money automatically. There are apps out there like Honey and Piggy. I like to use Honey. And literally, as you're checking out, if you buy something online, Honey will come up and they'll tell you, oh, do you want to save $20 on your order just by using this coupon code? Yes. And so now you just save $20 by doing nothing except having this free extension that helps find you coupon codes to help you save money on purchases online. It's the same with using a loyalty program or a cashback program, where now you're just saving money by doing nothing except just using one of these free programs that are going to save you money because you use the free program. And lastly, if you want to save $1,000 quickly, what I want you to do is next time you buy something, I want you to ask yourself, would you rather have that sweater you want to buy or whatever it is you're buying, or would you rather have cash in your hand? If you'd rather make $150 or have $150 instead of having a sweater, well then you can just not buy the sweater and keep $150, because now this is $150 that you get to keep in your pocket because you just didn't spend this money on the sweater now. You got to keep the cash and you don't get the sweater, but at least you got some cash. By the way, in case you were wondering, I did not pay $150 for this sweater. I think I paid like $9 or $10 for this sweater because I bought it online on clearance. For your property. because if the population is shrinking, there's less and less people for a limited number of homes. So if you have 100 homes in this neighborhood and the population is declining year over year over year, well, more and more homes are going to be sitting vacant. And I don't want to be investing my money in an area where this population is shrinking. And this is where now what I like to look for